Hey everyone! Today's video is going to show you how you can use historical events as a guide for modern financial protection and contrarian investment strategies. But before we dive in, please don't forget to hit that subscribe button and give this video a thumbs up. After this video, your investing strategy is going to change forever. And I'm confident this channel will become your financial compass. If you're ready, let's jump into the video.
All empires assure the resilience of their financial structures, and all governments act with the conviction that their promises are permanent. Yet, without exception, history proves these assurances to be hollow. From ancient Rome to modern-day Lebanon, from the Confederacy to the French Revolution, people across different geographies have tragically experienced the moment their savings became worthless, their wages lost their value, and the solid investments they relied on stole their future. Collapses are not rare exceptions. They are the expected outcome. The real question is not whether a financial system will fail, but how you will secure your personal safety when that inevitable destruction occurs. The idea that money will last forever is the greatest delusion in finance. We look at the amounts in our accounts and the strength of national currencies and assume they are unshakable foundations. However, cash is not a solid foundation. It is entirely trust. And that trust can vanish in an instant. This reality makes history both brutally harsh and highly instructive. Every collapse contains clues, examples, and warnings about which elements preserved wealth and which ones evaporated into thin air. When we observe these events, we realize that the survivors of these disasters were never the people who trusted the system the most. The ones who survived were always the ones who were skeptical from the start. Let's focus on the Byzantine Empire, for instance. This is known as the Eastern continuation of Rome, which managed to survive for 1,000 years after the collapse of the West Roman Empire. The core of its economic system was the gold solidus, a coin so reliable that European, Middle Eastern, and Asian merchants accepted it without hesitation. For centuries, this coin was the closest thing the medieval world had to an international reserve currency. But now we're getting to the main point. This is where things will really get interesting for our viewers. You would expect them to have learned a lesson from that old Roman fiasco, where rulers debased the silver denarius, turning it into just a silver-plated piece of junk. But that didn't happen. Centuries later, the Byzantine government repeated the exact same mistake, this time with their gold coin. They began to reduce the purity of the gold, diluting it and mixing in cheaper alloys. Initially, no one noticed, but soon after, confidence in the market was shaken. The valuable coin that underpinned all trade across the Mediterranean turned into nothing more than a product of political deception. The reduction of the value within the coin swept away confidence, and, consequently, the Byzantine financial structure lost its historical stability. Who benefited from this? Neither printed words nor official decrees. Secretly, in places far from imperial oversight, merchants who stockpiled real gold or land preserved their wealth, while everyone else watched their cash melt away. Here is the first timeless lesson. States cannot resist the urge to debase the value of their circulating currency. When they do this, the truly valuable move is to turn to assets they cannot counterfeit. However, not every economic collapse is caused only by those in power tampering with metal coins. Sometimes, this situation is more than just a shock born from an unexpected place. By the mid-14th century, Europe confronted the agony of the Black Death, which is considered the greatest catastrophe in its history. In the period stretching from 1347 to 1351, approximately half of the European population perished. Cities were deserted, settlements vanished, and trade networks ground to a halt. Despite this, the narrative surrounding the pandemic's cost was far more complex than just a simple misfortune. The loss of half the working population increased the value of labor survivors of the plague, thus gained the opportunity to demand higher wages. Food and land, which were once scarce, became relatively accessible due to the drop in the human population. Families who held cash, Liquidity, silver or commercial goods, or even those who just had the ability to work, suddenly gained an unexpected sphere of influence. Land that was once valued at a fortune could be acquired at extremely affordable prices. Homes were abandoned and fields were left unplowed. The plague survivors found themselves in an advantageous buyer's market. If this sounds unsettlingly familiar to you, that's no accident. We witnessed a contemporary example of this during the COVID-19 pandemic. Supply chains broke down, and governments printed massive amounts of money to keep the economic wheels turning. Consequently, those with liquid capital bought up assets, while those who struggled to make ends meet were left behind, creating a profound income inequality. While home prices in the United States soared and millions of average citizens struggled to afford rent, the stock markets quickly regained their former strength. Let's be clear. Pandemics redistribute wealth. This is an unchangeable historical fact. Black Death survivors leveraged the resulting scarcity of resources to elevate their social standing. Similarly, post-COVID-19 survivors with cash, liquidity, scooped up the real estate stocks and commercial properties that others couldn't hold on to. The takeaway is harsh but true. Economic turmoil rewards those who have savings while forcing the unprepared to pay the price. While pandemics reveal how quickly shocks can topple a financial structure, the Renaissance-era Florence banking crisis offers us a truth just as vital. Institutions, including those thought indispensable to the market, can vanish in a domino effect overnight. In the 1340s, Florence was the continent's financial heart. Influential banking families like the Bardi and Peruzzi operated in this city. These families had loaned vast sums to monarchs. However, the most devastating consequence stemmed from King Edward III of England, who became unable to repay the colossal loans he took out for his wars against France. When King Edward refused to pay his debts, the banking system completely collapsed. Account holders suffered massive losses. Economic activity ground to a halt. Florence, once prosperous and mighty, quickly descended into total chaos. The average citizen, who had trusted the city's powerful banking families, painfully discovered that the sheer size of an institution is no guarantee, and reputation is no shield. So, what conclusion did the public draw from these events? They saw that the concept known as too big to fail was a delusion as old as financial systems themselves. They learned that the purpose of financial institutions is not to ensure the survival of the individual, but simply to generate profit. When these institutions fail, they take your savings with them. This critical lesson resurfaces century after century, from the collapse in Florence to the Lehman Brothers crisis in 2008, and the Lebanese financial institutions locking accounts in 2019. Survival belongs to those who grasp that an institution's promise is only valid until the moment it no longer serves them. The United States Civil War is remembered for its frontline battles, political feuds, and the abolition of slavery. But behind the widely discussed conflict lay a merciless financial struggle that even today most Americans barely comprehend. Both the Union, North, and the Confederacy, South, realized that financing a conflict of this magnitude was only possible through printing money. The Northern government introduced paper money called greenbacks, which were backed not by gold reserves, but directly by the commitment of the U.S. government. Initially, this endeavor was perceived as both audacious and a patriotic move. However, the more greenbacks were circulated, the more their purchasing power dropped. High inflation eroded the value of the money and damaged trust in the system. The situation was even more dire on the Southern front. Desperate for funds, the Confederacy circulated an unthinkable amount of banknotes called graybacks. By the time the conflict ended, inflation in the Confederacy had reached unimaginable levels. Wages had essentially lost all purchasing power against prices that had risen by thousands of times. Soldiers' pay notes lost their value even before they could be cashed. People were forced to carry around sacks full of banknotes that could barely buy a single loaf of bread. By 1865, the Confederate currency was not just weak, it was completely worthless. What mattered at this moment of collapse were not paper promises, but assets with tangible value. Land, food, precious metals, anything inherently real, preserved its value, while money had become a cruel mockery. For the average Southern citizen, what happened was a complete catastrophe. A lifetime of accumulated wealth vanished in an instant. But for opportunists with access to tangible assets, the war was an opportunity to snap up real estate and wealth at pennies on the dollar, a true fire sale. This is a crucial lesson that Americans rarely listen to, but absolutely must not forget. Their own country has already experienced a currency failure. When this happens, security is not found in the banknotes in your wallet, but in preserving assets whose value the system cannot destroy. French history also provides a brutal example of how revolutions can obliterate currency even faster than wars. In the 1790s, as revolutionaries overthrew the monarchy and seized church lands, they introduced a new paper currency called the assignat, which was theoretically backed by the value of these seized properties. The goal was to stabilize the national finances. However, the government began printing this currency without restraint. Every new issuance reduced the purchasing power of the previous ones. The prices of goods skyrocketed, and workers' wages couldn't keep pace with the increases. The assignat quickly became worthless. Farmers refused to sell food for paper money, demanding payment in barter or silver instead. Food riots broke out again in Paris, and the revolution began a process of self-destruction. The people who profited from this collapse were not those who held on to paper money out of national loyalty. Instead, the successful ones were those who held tangible assets that the government couldn't produce: food, precious metals, or real estate. The average Parisian citizen realized this truth far too late. Promises, no matter how noble the cause they serve, are only worth as much as other people are willing to accept them for. When trust vanishes, your savings don't just shrink, they completely evaporate. If we fast forward the calendar 2 centuries, this crucial lesson repeats itself once again, this time on the continent of Asia. In 1997, a speculative attack on the Thai baht quickly escalated into a regional crisis. Thailand had taken on massive amounts of foreign debt denominated in US dollars, trusting that the exchange rate would remain fixed. But when the fixed exchange rate collapsed, those foreign currency loans instantly became unpayable. Capital owners rapidly pulled out of the market. The national currencies of Southeast Asian nations, including Indonesia, Malaysia, and South Korea, lost value in a cascading reaction. National economies contracted, and unemployment rates soared. Governments were forced to beg the International Monetary Fund, IMF, for help to find a way out. The ones who suffered the most were, predictably, not the global hedge funds who triggered the panic. The affected parties were ordinary citizens whose savings evaporated, whose mortgage payments doubled, and whose jobs vanished. Yet, the emerging picture showed an uncomfortably familiar reality. Those who held US dollars or foreign assets weathered the storm better than those who trusted the national currency. While governments dependent on foreign credit were forced into austerity measures, giant Wall Street financial institutions scooped up Asian assets at fire sale prices and left the region. This event, which felt like a local collapse, was essentially a global transfer of wealth. This lesson makes itself felt in every collapse, from the Byzantine Empire to Argentina. Taking on debt in a foreign currency is a trap that drives people into disaster. When economic turmoil hits, the party who pays the price is not the creditor, but the person who owes the debt. By this point, the main contours of the situation should be clearly visible. Whether we look at revolutionary France, the American Civil War era, or modern-day Asia, the same core motifs constantly recur. Paper currencies lose their value, and debt burdens shackle nations and households. And the survivors of these processes are far from being the ones who believed in the system the most. The survivors are those who could grasp the system's weakness before it even broke. The most chilling aspect of history is that destruction isn't limited to ancient times or the distant past. This reality persists even today. Between 2019 and 2021, banks in Lebanon took a step that most people in developed nations couldn't even imagine. They locked the doors of their branches. The public woke up to find their deposits frozen, cash withdrawals restricted, and their national currency melting away. The Lebanese pound lost over 90% of its value. A lifetime of savings was reduced to the level of insignificant pocket change. Citizens formed desperate queues outside bank buildings, pleading for access to their own cash, only to be told their money was simply no longer there. Furthermore, the affected parties were not just those who saved small amounts. Middle-class families, retirees, doctors, and engineers suffered the same fate. Everyone who relied on the financial structure suffered a massive loss. The lesson learned was sharp and clear. The amount in your bank account is not the content of a treasure chest. On the contrary, that money is a loan you provided to an institution that can decide not to pay you back during a crisis. The ones who survived this situation with the least damage were those who had either diversified their investments abroad, held tangible assets like gold or real estate, or kept their cash outside the banking mechanism. Everyone outside of these groups was left helpless. If these events seem foreign to you, they really shouldn't. In 2008, despite the banks that caused the crisis being bailed out, U.S. citizens helplessly watched their homes foreclosed and their retirement funds disappear. In 2020, trillions were printed to keep the economic order afloat during the pandemic. This acted as a life raft that rapidly inflated asset prices for the wealthy, yet left average wages stagnant. Then, in 2023, regional banks in America suddenly collapsed overnight due to depositors losing faith, reminding everyone that the supposed safety of being too big to fail was a delusion we told ourselves right up until the doors slammed shut in 2023, our faces. So, how do you secure your individual safety when everything starts to fall apart? Past experiences reveal that there is no single answer to this question. In the Byzantine era, the solution was holding gold. After the Black Death, the liquidity needed to acquire vacant land was crucial. In Florence, refusing to trust the massive bankers was the path to salvation. In the Confederacy, physical goods retained their value. In France, food and real estate were safe harbors. In the Asian crisis, avoiding foreign currency debt was essential. And in Lebanon, the smartest move was withdrawing money from the system before the banks locked their doors. Although the courses of action in these examples vary, the fundamental principle always remains the same. The ability to survive doesn't come from unconditional trust in paper documents or institutions, but from knowing what assets retain real value when all illusions have dissolved. And here is the paradox that should wake you up. Economic collapse is simultaneously both a disaster and an opportunity. For the unprepared, it means absolute destruction. But for the resilient, those with liquidity or assets that cannot be printed and debased, this is the moment to acquire wealth at a fraction of its former cost. After the Black Death, because there was so much land to be worked but not enough manpower to do it, even ordinary peasants were able to acquire land. Following the 2008 crisis, those holding liquid capital swooped in to buy homes while millions of individuals were foreclosed upon or had their houses repossessed. History shows us that the act of protecting yourself is not just about defense. It is also about positioning yourself strategically to scoop up assets that the distressed are forced to abandon. However, wealth is not limited only to what you own. It is also closely linked to what you can produce. The survivors of historical disasters were not just people who owned gold or property. They were the ones who possessed the skill to generate value, even in moments when others failed. For example, the baker who could still provide bread, the craftsman who could repair tools, the farmer who could supply the public's need for food, the merchant who could move goods beyond national borders. These individuals weren't just the survivors of collapse. They were the ones who rose to prominence during the turmoil. In every crisis, cash loses value, but the act of production never loses its worth. Humanity cannot abandon the necessities of eating, building, trading, and surviving. And those who have the ability to meet these fundamental needs will not remain poor for long. This is the true and most fundamental security. Not the unquestioning faith in institutions, not the hope that governments or banks will save you, but rather the convergence of tangible assets, acquired real skills, and the knowledge that all illusions will eventually shatter. Every crisis is a transfer. It is a transfer from the trusting crowds to a small, cautious few, from promises on paper to assets with tangible value, from passive savers to active builders, producers. History has demonstrated this trajectory repeatedly. Therefore, the question up for debate is not whether everything will collapse or not, because everything always collapses. The real issue is whether you will be one of the many people holding only promises at the end of the process, or one of the few holding a tangible asset. History does not repeat itself exactly, but if you fail to heed it, the consequences will still maul you.
This is History of Fortune, where the numbers tell human stories, and the story always leads back to us. Take care of yourself, and see you in the next videos. Goodbye.